Welcome, everybody, to today's episode of Open Yield Markets with Mark. We are thrilled and excited today to have the Czar of macro credit strategy on our podcast, Peter Tchir, who is head of macro strategy at Academy Securities. Peter is a 30-year veteran of Wall Street, spent time during the crisis at the sell side running credit derivatives trading operations for the last 10 plus years. He's been focused on helping asset managers with macro strategy, and not just asset managers, everybody in the asset class. So we're thrilled to have him here today. And one thing that's pretty unique, which we'll talk about a little bit later today with Peter, is he has a lens into the geopolitical arena, which is ever more important. He's created this new term. I don't know if it's trademarked yet or in trademark, but we'll talk about it a little bit. But I think it's very interesting, especially as this administration really focuses on a lot of the geopolitical arena, what it could mean for markets. So we're thrilled to have Peter Tchir today, the Czar of macro credit strategy. So to start out this cast today, the Fed came yesterday. It was business as usual. No cuts. Dot plots were pretty much in line with what the market thought. My stance is with Powell on the way out. What's your take on the rest of Powell's time here? What do you think is in the Fed's toolkit? And give me a little overview about what you think happened yesterday and the quick forward for the Fed.
Perfect. So one, I actually think there's a chance he cuts. He only is going to be in charge for 2 more meetings. And part of why I think he might do it is I view that he took this meeting, he built consensus around no cut. So I think he showed himself that, hey, I'm not going to be forced into doing something. But when I listened to what he was talking about, specifically one time he said, jobs is more important than GDP. So he would err to the side of my favorite part of the jobs data that we get the JOLTS quits rate. And the JOLTS quits rate kind of, to me, it's a crowdsourced number, right? People in lower income jobs quit when they get annoyed with their boss and they know they can get another job next week or 2 weeks from now. They don't quit when they're a little bit nervous, like, shoot, I got to keep this job. And people are all well aware of how easy it is to move or not. So when that quits rate low, it tells me people are a little bit nervous about the job situation. I also kind of watch law school applications have been going way off the charts. And to me, if you can't get a job graduating college, law school is not a bad way to raise your hand. I'm still hopeful my son graduates and gets a job, but you can see this path kind of developing. It's very hard right now. And a lot of companies, I think, would traditionally hire people in September, October for next year. I think no one really knows what the economy is looking like, where they are, what they're doing with AI. So I think the jobs is going to be weak. And then on the flip side, I'm far less concerned about inflation, I think, than even the Fed is. I look at Truflation as one measure. So you can pull up Truflation, and it's kind of more of a measure of real-time inflation. It predicted inflation ahead of the Fed and CPI back in 2020, and now it's saying we're at 1.4%. So it's not quite as holistic as CPI, but it's a useful measure, and it's come down from 3% pretty rapidly.
Peter, a lot of our listeners are industry pros, some are academics, but just for some of the laymen's and some of the quote unquote average Joes out there who are listening to our podcast trying to learn more about financial markets, could you just walk through a little bit more about what Truflation is versus, in the inflationary gauges where we might be accustomed to knowing?
Yeah, so Truflation, it was created, I believe, by MIT professors. And what it does is it kind of goes out in real time using the web to get prices of things. So it's kind of comparing a basket of items constantly, but it's using internet pricing. And I don't think it does any of these adjustments the Fed does. And so I think it's probably more accurate in many ways than kind of how the BLS goes about, the Bureau of Labor Services goes about collecting CPI data. So I like that. It's more for, goods and grocery type things. And then the other thing that's very important to me, and this gets a little bit wonky, but on shelter and homes, the Fed uses what they call owner's equivalent rent. I will admit I'm reasonably smart, and about every year or two, I go to the BLS page and I look at owner's equivalent rent. I can't understand it at all. And it's kind of figures out what someone with a single family home would probably rent it for, which is a weird question to ask. And supposedly, if you go back 50, 60 years ago, people actually commonly rented single family homes. Now, a vast majority of home rentals are apartment rentals. So why we still try and figure out what a single family home would rent for makes no sense to me. And I look to something, I look at Zillow. Zillow publishes real-time rent, and it seems reasonably accurate. And again, in 2021, it was showing inflation in rent well before it showed up in CPI. And now it's showing far less inflation than CPI is telling you. So I'm kind of like, I think we're using this old data. And some of the reasons this particular Fed, I think, got stuck in transitory mode is they were using the official data when other sources of data, I think, were telling you a different and more accurate story. I think we're going through that right now. Having said that, what's neat is because of the government shutdown, they're having to look at more sources of data than they might otherwise. And certainly, I think if you get someone like Rick Reeder, who would, if he comes from BlackRock and he was formerly at Lehman, if he comes into this, I think he's very used to looking at alternative sources of data, and we can go through this maybe a little bit better. And that's what I would love to see. Like, I think, and bizarrely enough, I did not know this until 6 months ago. The BLS can change some of their job calculations relatively easy. They cannot change their CPI calculations without going to Congress because CPI flows into Social Security, cost of living allowance. So it actually has to go through Congress. But these are things like we're living with data collection that was maybe semi state of the art in 1990 that is nowhere close to state of the art in 2025.
So a big difference in what the data is, how you can get it, and what you're basically saying is some of the indicators that you use take a lot of the lag out.
Yeah.
So it is, yeah. So, housing and services was a big stalwart of why inflation was kind of pegged higher, not coming down. And so, what you're saying is there's some confidence that housing has stabilized lower, and services, I think we all are understanding has stabilized a little lower as well. So you think, more cuts are coming. Now, I guess the question would be, and Powell skirts this pretty nicely. He did yesterday in the presser as well. Do you think he cuts because he's following his job on the way out? Or do you think there's any political reason why he might not cut and let the next
Yeah,
Fed chair cut? Or what do you think about the politics? Or do you think he's just business as usual?
so I think he's more or less business as usual. And to be honest, I think it would almost be business as usual with a slight smirk if he cut once. And he said, listen, President, I told you I would cut when appropriate, and I'm now cutting because it's appropriate. So I think that would almost be a bigger, you know, gesture to the president than stubbornly not cutting. So I think if the data at all points, I think he might actually lean towards cutting. I don't think he could cut this meeting because the data wasn't there. And then it would also look too much maybe like he bowed to recent pressure. So I think the best thing to do would be the president to kind of lay low on complaining about Powell too much. I know you have to send the obligatory anti-Powell thing out after the FOMC. I think that would let the data speak, and if the data speaks to a cut, I think Powell and his team will get on board with the cut.
Okay. So one thing that you mentioned earlier that I want to kind of just drill down on a little bit is jobs versus GDP, economic strength versus weakness in the labor market. And I know you talked about it a little bit, but your lens is saying, hey, jobs are more important than GDP. At the end of the day, you think cuts are coming because the Fed cares about one side of the mandate more than the other.
Yeah, so definitely Powell yesterday did say he cares about the ones he's trusts the data better in that. And then, GDP gets a little bit wonky as well. So, we've cut back on imports as part of the tariffs and things like that. Well, that actually makes GDP go higher. So GDP takes away imports. And the other thing that's supposedly been inflating GDP is we've been exporting gold. And when you sell gold as an export, so some percentage of the GDP data seems very tied to gold and the fact that gold's been rising and the US has been exporting and some has just been moving it around. I think some of the big banks have been putting it to the LME, the London Mercantile Exchange, where they've needed to settle contracts. So that to me is a little bit fake GDP, right? It's getting away from, you and I think about real industrial production and real domestic product. Some of these things I think are a little bit artificial. And that's why I think you can downplay GDP a little bit.
End of year, who do you think the next Fed chair is going to be? Short list is out there. What are your thoughts? If you have confidence in that thought, what do you think about this person's outlook? And then end of the year, how many more cuts? Where do we end at the end of the year?
So before I answer that question, there's been so much focus on Fed independence, which I think is right. But on the other hand, cooperation and coordination aren't a bad thing. So I think we should see more cooperation between the administration, the Treasury, and the Federal Reserve. And we've seen that in times of stress during COVID, right? They all work together to do things. We saw that in the GFC. So I think we can have an independent Fed and still cooperate more aggressively in policy with the Treasury Department. And I think this Fed, no matter who it is, I think will also be a little bit more concerned about controlling the long end of the yield curve. I think they will be quicker to act if they see long end yields rising, that they will do some sort of operation twist where they sell the front end to buy longer dated bonds.
You're saying that we might see Operation Twist Part 2.
I think we will. I think if anything happens to kind of force yields a bit higher, we will see an operation twist. And Rick Reeder, if he comes on board, I think he is currently the betting favorite. I would like to see him because one of the things that has always bothered me about the Fed is they all seem to come from a very similar background, right? All macroeconomists of one form or another. If you even just look at the economics Nobel Prize, it's been going to behavioral economists, right? So why isn't there a behavioral economist there? And I think, as we all know, I have time joke, if I knew what non-farm payroll was going to be, I'm not sure I could make money or not, because it's not just knowing what the data is, but how's the market positioned? How's it going to react to that? So having someone thinking a little bit more about how the market reacts. And one of the things I always hated about QE, or when we were going, QT, we're going to buy 30 billion a month. And then, ooh, in 3 months, we're only going to buy 20 billion. Why do we need this level of precision, right? When the Fed was even talking about hiking during the transitory, they were still doing QE, which, like, that's blows my mind. They should have, hey, we're even thinking about hiking, let's end QE. And I think they would be much better served, like, hey, we might buy or sell 50 billion any given month. If yields seem to be going higher out the curve than we think they should be, we'll buy. And manage it a little bit more fluidly. And I think that's what we would get if someone like a Rick Reeder, who with real bond market experience, comes in. And I would like to see something a little bit shaking up where you're not all the same thought process. And, I hate to say this, and, I know some of the Fed people, like, not a single person got fired after missing transitory. In any other job, someone's head's got to roll. Like, hey, we can't have the same people. And don't know how many of your listeners trade, but when you trade, so you have stop losses, right? And the reason I think you put a stop loss in is because your judgment goes bad. Say, I'm going to buy a stock at 100. I think it's going to 120 and goes to 90. Your first reaction, I should buy more, right? This is now going, I'm going to make even more if I buy. So you do the stop loss to pull you away, let you rethink your strategy. We have all the same people who miss transitory. That's why I think it's so important when I see this data that's showing that real-time data is showing that the official data is lagging again. And I think they're making the same mistake in the other direction. Instead of, they're not cutting fast enough because they're so scared that they made a mistake before.
So
Get
you're
over it.
saying a more active, even, not even a passive strategy, but an active strategy in the Fed, which allows them flexibility in a sense to trade the market a little bit.
Yeah, I think they will look to control this again. If I'm thinking about anything on rate side, I listen to Besson. So I do think we're going to get 3 cuts. We're going to be sub 3%. That's what Besson's talked about. The president talks about 1% on Fed funds. That's not going to happen. But I could see 2.875, which would be 3 cuts. I think we get them by September because they want it for the election. I do think there's a chance that we get one of those cuts. But if you go back to September 2024, when they cut and long end yields went higher and higher, they're well
Which is
aware of
what's
that.
been happening this cycle as well.
A little bit, but now we're still at 425. I think they're going to pay more attention to where tens are, and they will take steps to do this, because the other part of Trump's agenda is housing affordability. Mortgages lower helps. They announced 200 billion of Fannie Mae purchase of mortgages. That helped the spread of mortgages to treasuries go down. So that's one component. But mortgages price off the 10-year treasury. So if you can keep the 10-year treasury lower, that also helps mortgage rates. So I think people, and this is probably the pushback I have even with more traditional Wall Street people, like, oh, well, they wouldn't do that. That would be unusual for them. Everything about this administration is unusual. Going and capturing Maduro is unusual. Like, if they want 10-year rates below 4%, why do you think they won't try some excessive sort of new strategies to get them below 4%?
So you're saying not just don't fight the Fed, but don't fight the administration. The
Yep.
administration has a goal of getting rates lower and even at the long, getting mortgage rates lower. Are you favoring flatteners here?
Yes. So I kind of like flatteners here. I like being long, longer dated yields. I think it's going to be under control. And I think, yes, under traditional means, we would probably get that sort of reaction we had in September 2024. I think they're going to prepare this. Howard Lutnick, who may have many issues, one, though, he understands the bond market pretty well, and he has people working for him who understand that. Like, Besant understands these things. And if I'm right and they artificially keep, say, 10 years lower than they would be on natural basis, that probably means there's pressure on the dollar, which this administration would clearly view as a feature, not a bug, right? This administration would love a lower dollar. So keeping yields artificially low at the long end, causing the dollar to weaken, like that's a double win, I think, in their books. Now, at some point, you might want to fight it, but I think people are fighting it early.
So let's say GDP stays uber strong. What's your take if we have this robust economy? Do you think we can still pivot towards the 75 basis points a cut, or do you think that somebody gets in the way of that and, puts the academic hat back on and says, hey, wait a minute?
I think the one thing that does concern me is if, commodity prices continue to skyrocket. And we've been seeing, again, good thing we're having this conversation this afternoon rather than this morning when everything was going crazy high, but, copper seems untradeable and things like that. But that's something I'm keeping an eye on. I think commodity prices, if they keep that upward pressure, that gets a little bit problematic. Having said this, I think there is this real ability to keep inflation under check. And I think if we're under 2.5% in inflation and jobs are all sketchy, we at least get 50 bips. So I think it's going to take a pretty tough thing to change the mind of whoever becomes the next Fed chair. And again, I still think the data is going to lean towards Powell cutting once.
So I know you're not a S&P forecaster, but everything we're talking about tells me stocks are going to 8,000 by the end of the year. Well, what derails the market, or are you very bold up on the outlook for stocks if in this case?
So I agree. I think like I was a bit surprised again. I thought post FOMC stocks would do okay, and futures are doing okay until they tanked this morning. Now they're bouncing a little bit. I like owning things that produce electricity. I think no matter how this data center AI thing plays out, um, we need more electricity in this country. Literally every place I go, people are talking about the price of electricity. I was speaking to a fairly large audience in Baltimore on Friday and had a chart that showed electricity and CPI. And it basically from 2011 to 2021, it went up 4% in total. Since 2021, it's gone up 40%. It's literally an election issue. It is hitting everyone at every level of the income bracket. It's a big part of the affordability problem. The data center and AI, sucking it in more. So I think we're going to see production. I do not own wind because I don't think Trump's ever going to cave on wind. I do own some solar because I think he will have to cave on solar, and that's kind of my low beta play. I like uranium. I like some of the nuclear plays, and that's kind of a bit more high beta. Obviously, like it moves around a bit, but I think we're moving that direction. All the rage was GPT 2 years ago. ChatGPT seems like it's, I don't know, third or fourth in the list right now when people want to talk about what they're using. Llama, that I don't know if anyone ever actually used, but it seems to be off the radar screen now completely. So I don't know if we know who will win or who will lose. So I kind of like to own it from the energy perspective. I think we're going to have to build out electricity. We're going to have to build out, and this will kind of come back and maybe a good time to introduce what I call production for security, where so it's ProSec has kind of been the term we put to it. And it's really started as national production for national security with some resiliency. And that's way too long and more than to say. So we've kind of shortened it to ProSec and production for security. As a nation, we are going to go and examine what are things that we are dependent on other countries for that we should be more self-reliant on. Doesn't mean we have to be a wholly self-reliant. Electricity is up there. The refined versions of rare earths and critical minerals are up there. So again, I want to own smelters. I want to own refiners. Yes, the extraction and the mining is interesting to me, but the real bottleneck right now, and China controls about 90% of all processing of rare earths and critical minerals. They control a decent chunk of the processing, or sorry, the smelting of copper. So I think that's going to be a higher priority. We have taken a couple of companies through this administration working on kind of getting some financing for them, smaller companies. And there is a clear focus on the refining, processing, and smelting part, because that's what we're at complete mercy of. You can kind of buy the other things on the market. Yes, and not all from China. Whereas the bottleneck where China can turn it on or off right now is there. I like chips, for example, so I'm also playing it through Intel. I think we need a domestic chip provider. Maybe in an ideal world, we have guardrails, and if the US government buys 10% stake in a company, here's the rules of engagement for the US government. We don't have that. Like we have the president took a stake on behalf of the US people. We know the president likes to win. So we know the president will massage and lean on people to do things to win. So I think Intel is going to, I think Intel actually has some really good technology and is doing a decent job of separating its foundry business from its design business, which that's always been a bit of an issue, I think, when companies deal with them. So that's been my big play in chips is I like Intel. I continue to like Intel because I think it will benefit from this production for security. Some of the other companies that are making it onshore will do as well. I just think that 10% stake Trump put in will mean that he pushes for people to use them as well.
And what you're saying is you really like the infrastructure behind the seismic shift into AI and to what we're seeing. Rather than pick the winners of the end product, you like the suppliers of what goes into the end product.
Yeah, and especially at these current valuations, right? I think so much has been priced into the the big hyperscalers and things like that. I feel that they are more fraught with change, and you just saw it today. Meta's up 10% or something. Microsoft's down 10%. So I feel like if you and now all the uranium stocks and stuff are down 6% today, but I feel like the energy infrastructure is really crucial. And again, if we're going to bring back manufacturing, someone brought out an interesting point to me. We did not have a big increase in energy usage for the last 20 some odd years until recently. And a part of that was we kept offshoring production. And a lot of production of things is actually fairly energy intensive. So not just our EVs, not just the data centers and AI, but if we are going to smelt, if we are going to do these things, we need more and more electricity. And I think that's just something that's kind of natural. And so when I talk about this production for security, my first leg was that the US government jump started this. What's going to drive this and keep this going, I think has already started, is capitalism. And you saw JP Morgan, they've allocated 1.5 trillion to these types. They're not calling it ProSec, but if you look at what JP Morgan's allocated 1.5 trillion and what I'm saying, the overlap is pretty high. And I think if JP Morgan does that, other banks who are saying, well, what's the biggest and best bank in the country do? Ooh, we're going to do a similar type thing. We talked to some European banks, and they mentioned that they were really nervous that this year they wouldn't get their lending out in the US because a lot of their lending was predicated on ESG. And in the end, they were able to say, but we can actually fund a natural gas fired plant because this region needs that energy to be sustainable and resilient. So they're twisting some of the sustainability definitions to what I mean is probably more truly sustainable. And when I think of this world, if you think about a human equivalent, and this is where I think ESG maybe went a little bit wrong. Humans need air. You don't live with air for 5, 6, 7, you die. You can live without water for a day or two, then you die. Food, probably close to a month before you die. Changing temperatures, years, years, and years and decades. So I think we kind of lost that order of priority. So when I'm looking at what do I want to invest in on this production for security, what are the things that if we lost access to it from China in particular, because they're our biggest friction, would we be in deep trouble on? Chips, we would lose access not because China produces them, but China could disrupt trade from Taiwan. They've got chips, they could do all sorts of things to try and reduce that trade. So we need chip production here.
So the administration has started doing this, but you think this continues? You think investments in U.S. companies or other in the ProSec area continues? And at the same point, you probably have some sort of a put built in as well for like an Intel or something of that nature.
Yeah. And as US investors start looking at this and eyeing these investments, they're seeing opportunities. People are, looking for mining rights that have been unused. They're searching for patents in rare earths and critical minerals that haven't been relevant because we kind of deindustrialized. So corporate America is coming through. And then I think you're going to see other countries have to develop this, right? Whether they like it or not, Carney, and I'm Canadian. I think his speech was somewhat weird in many ways, but the reality is every country has to be somewhat independent. I had a long conversation this summer, and she was a baroness who's in the House of Lords in the UK, and she was talking on and on how the UK was going to be great at data centers. And I was like, how can you possibly be good at data centers and AI when you have the highest cost of electricity in Europe? Just nonsensical to me. And then she's like, we get it from France with their nuclear. I'm like, well, 3 years ago when France had a drought, their nuclear power dropped. They were more expensive, and they're going to protect their own people. So I think at every level, each country is going to be forced to do a little bit more buying and development on their own. And so let's call it X is you do it domestically, Y you do with your close allies and neighbors, and the last little bit you can buy who from ever most expedient. And that amount of X is going to depend a little bit on your situation in your country. So there's no reason on electricity the US can't be 120%, be net exporter to friends. On some things like potash, we're probably going to still need to import some because that's the nature of the beast. So I think as you look at these things, and each country is going to be slightly different. And clearly, the one big pushback, well, what happens midterms and all these? I don't know, but I'll take 2 steps back and say, one, Trump put in a bunch of tariffs against China that were along some of these lines. The Biden administration kept them all in place. The Biden administration did the CHIPS Act, right? So the Biden's administration clearly learned and was well aware of the need to do chips domestically. So they took that step. And just now, I think there's a $2.5 billion bill trying to go through Congress that was bipartisan to do the rare earths and critical minerals. So it's gaining momentum. But to me, if capitalism starts going this way and you start seeing some, production for security type ETFs and stuff, it has a momentum of its own. And I think it can snowball.
I was about to say, listening to you, I'm thinking to myself, rather than, well, I could do one of two things. I could listen to people like you in general who have views on single name stocks, but the best way to do it for mom and pop might be just to buy a few baskets or ETFs in this arena and let it play out a little bit.
I own some ETFs on this. The one thing I would say, and I would look at some of these ETFs, say some of the uranium ones, and there's multiple of them, and go through and look at some of the companies and look at the weightings. And I want to avoid those, a lot of and more so in the rare earths and critical mineral side. There's a few ETFs that are heavy on Chinese companies. I don't want to own China. They are not going to be our friends in this. So I want to make sure that the ETF holds more American stocks. It doesn't have to be exclusively, but you kind of want to make sure you check that out. I think Central and South America will be big parts of this. So you can buy some ETFs that let you benefit from that because, again, if you want to do one thing, the national security strategy piece came out about 2 months ago. You can look it up. It's about 39 pages of double spaced. It's a pretty easy read. And that tells you like we are going to focus on North, Central, and South America. Shipping is going to be safer, North, South, Central America. It's going to be more dangerous to ship from Thailand and Vietnam. Doesn't mean anything's going to happen, but I think that's going to be the growth. And you look what we've done in Venezuela, you look Argentina, we're helping. So I like owning things in Central South America. I currently like owning through an ETF, emerging markets, local currency bonds, because I think the dollar is going to devalue. I think yields come down here and they'll come down in emerging market countries as this goes on. So there's all sorts of interesting ways to play this via ETFs as well.
If there's one way to get rates lower, it's to continue having what's happened to the dollar continue.
Yes.
Which, like to your point, this is a lot of it's political and driven politically by the administration. One last thing before we wrap it up is you are thinking that everything we've talked about today has a lot to do with the midterms coming up later this year. How do you see this all intertwining? What's your take on the midterms and what's going to happen ahead of them?
I think the Trump administration is going to try and do things to boost the stock market, make affordability. I would not be surprised to see some things come out on drug prices, maybe even on home insurance, auto insurance. Where again, I don't know whether it's even going to be legal, but I think they're going to say things to try and look at keeping some of this affordability down, right? Even on electricity, they're talking about forcing the data centers and AI to build out their own grid improvements and things like that. So I think it's all about affordability. I think that's the direction he's headed. It can work. I think there's a lot of, opportunity. Same time, some of what he's done, I think, there's risks to me are, do Europeans want to buy US brands today the way they did 2 months ago, 6 months, or 2 years ago? What scares me, I think, with the Trump administration has been when he took over Trump 1.0, you pull up his org chart. He had 5,000 some odd LLCs, right? He has a series of deals. He did not have an org structure. There's no one you can really look to, like, who's his team? Who's his team that's been with him for 20 years? If you look at Jamie Dimon, you look at various people, the 2 or 3 people that have been surrounding them all these time, and you can get away with that in real estate. Okay, if you piss off every developer in Chicago, you go to New York. There's only 20 some odd countries, and we keep going after them. And in our business, one of the worst things you can do is retrade, right? If you do a bad trade, you can't yell and scream at the broker. It's just at some point, no one wants to pick up your phone call. If you're the UK and you thought you had a trade deal and all of a sudden you're getting 10% tariffs because you did something with Greenland, who you are actually obligated, there's a lot of risk to this. And I think the tariff stuff is just slowly hitting. And I'm worried that the AI spending is artificially making the economy seem good and the GDP look good. Well, below the surface, small businesses, people are struggling. And at some point, this kind of optimism, okay, things are about to get better, ends, and you kind of see a real slowdown in consumption.
Listen, Peter, one thing we do at the end of every podcast here, we do just a set of quick hits. I ask you off topic. It doesn't, it has nothing to do with markets. But earlier in our prep for the audience, Peter told me he was on the road 100 nights last year. So he's a world traveler. If you take it in business days, that's about one every 2.5 days. One every 2.26 days, thereabouts. What's the favorite place you traveled in last year?
I got to say, I do like the San Diego area. Our headquarters are in Del Mar. You really can't go wrong. When people there complain, like, "Oh, it's 73, it's hot," or "Oh, it's 69, it's freezing," you're in a pretty good place. I enjoy that, but I have to say, I enjoy going to some of these small, former industrial towns, and some are interesting, some are, kind of ghost towns, which is depressing. Some are regrouping. It's just that different perspective. One thing I would say is traveling all over the country, and I see people for asset managers, corporations, municipal. I'm pretty sure if you picked any 20 kind of decision makers from any parts of this group and put them in a room, they would come up with a pretty useful solution for the US where there's some give and take. And unfortunately, I don't feel that random group of 20 people is who's selected anymore. And so that, I think, is the biggest disconnect I have, is for all this apparent discord, and gosh knows I spend too much time on Twitter where that's all you see is discord. The real people who are decision makers aren't that far apart. And that gives me some degree of comfort that there is this way to do things right.
Okay. What about the favorite restaurant in the world?
Almost anything in Madrid. I love Madrid. In the US, I have to say I love this place, Maria. It's like Italian crudo.
Yeah, it's right on Central Park South. Yep, beautiful.
It's an expense account sort of place, though.
It is, and it's not a PA place.
I am lucky because Phil McConkey, who's the president of our company, former New York Giant, he likes to go there. So whenever he's set up a business meeting that I get invited, it tends to be there. So it solves all the bills.
And then 2 more questions. You go to a bar. What's the cocktail choice? What's your order?
Kettle One and soda.
Kettle One and soda. Very old school. And then I see
With a
behind
slice of
you.
lemon and lime. There you go.
There you go. I see behind you about 1,000 books. Probably most of them are nonfiction, I'd imagine, as you're doing deep work. What's your favorite fiction work that you've ever read?
The 2 I go back to, I guess maybe one's not fiction. I recommend Animal Farm, my favorite one. And partly, the only thing I would say, it's clearly meant about, how the communists then become capitalists. I view it a little bit like whoever you kicked out, you become like. And I'm a little bit worried that applies to the US where the same families are taking over everything. And we kicked out the peerage system, we're coming back. And then Liar's Poker, which I guess is not quite a work of fiction, but those are the 2 books I go back to read all the time.
Awesome. I appreciate your time today. This is Peter Tchir. It was a great podcast. Thanks for your time. This is it from Open Yield Markets with Mark, the modern bond marketplace. Thank you for your time today, Peter, and we appreciate it.
Thanks a lot for having me. I enjoyed it.